The Bank of Canada is about to cut interest rates for the third time this year, and there is no sign of them stopping anytime soon. That's the belief of most financial markets right now, and it's going to have a significant impact on real estate. But maybe not in the way you think, because the outcome of lowering rates this fall will be price declines will continue, contrary to what most of your realtor friends are telling you in their stories or on TikTok. And no, it's not all bad news, because this is exactly what happens on the path to price recovery after market declines like we have seen over the previous months and years. But really quick, before I get into why the market will continue to dip, regardless of the inevitable interest rate cuts that are going to continue to happen, I'd love to invite you to subscribe to the channel if you are interested in staying up to date on my market here in Surrey, BC, and across the entire country. Please click the like button for Tiff Macklem, triggering the release valve on the pressure cooker that is the economic markets in Canada. And of course, if you're looking for help navigating a purchase or sale in what are absolutely volatile times, well, you can book a call with me right now using the link in the description below at a time that works best for you. Now, the first indicator that there absolutely will be a cut coming in September, and I believe the date of that is September 4th, is the simple fact that inflation fell again, even greater than people had previously thought that it would, down to now only 2.5%, which is not that much above the rate of 2% where the bank wants to see it. We are in the possibility here of slipping into even lower than that, of where they will cut rates even faster. The bank does like that nice, healthy 2% growth rate. Now, the current interest rate is at 4.5% for the overnight bank-to-bank lending rate. And there is a very good argument, and mostly accepted argument, that the interest rates need to be somewhere around close to 2% over top of the inflation rate, and that's basically exactly where they are right now. However, the inflation is trending downwards. So that leads everyone to believe that it will continue to trade downwards as the economy slows down. As a result, there will need to be some stimulus put back in. The only stimulus tool, or whatever the opposite of stimulus is, tool that the Bank of Canada has is interest rates. So if the economy is overheated, they slow it down by increasing rates, is what they've exactly done over the past couple of years. And now we are seeing the slowdown happening, and we need some more stimulus, or let's rephrase that a little bit. We will need more stimulus in the future. And once these announcements are made, they don't really bake into the system for 12 to 18, sometimes even 24 months. So the damage that we're seeing in the economy right now, and a lot of it is likely from the bank over tightening in the first place. There's a lot of economists out there, for instance, Benjamin Tao of CIBC, that thought that they should have stopped at 4.5%. So they actually over tightened, and now they've released the valve. And even though the economy's slowing and we're coming off, there's a really good chance that coming off of those higher rates at 5% was too high in the first place. But the big misnomer out there is that this will affect anybody in the mortgage world. And at this point, it's not really. If you have a mortgage, you're only affected by this if you still have a variable rate mortgage. And variable rate mortgages were upwards of 6.5%, 7%. If you have a line of credit like I do on my house, something like 7.7% at one point. So anybody that was really stressed at that time that had those really high rate mortgages hopefully has flipped into a fixed rate product, maybe around 5 or 5.5%, and they're still not affected by any of these changes, most likely. And let's say, for instance, right now you do still have a variable rate mortgage and you're at, let's call it 6.25%. You still need 3 more cuts before you get to a spot where you could get to 5.5% on your mortgage. An easy number you could have secured over the past 6 months, absolutely no problem. And even further to that, some of the fixed rate products, definitely the 3-year products and many of the 5-year products, are now starting to come down below 5%. But that is tied to something completely different, which is the bond market. This is a chart of the bond market. This is easy to access for you on the Bank of Canada's website. You can check it out wherever you want. Particularly this chart, or what I've selected here, is the 5-year bond yield. This is basically a best guess about where rates are going to be in the future. And this is what your 5-year fixed rate is tied to. So you can see back here in 2002 was way up at 5.1%. I want to say in 2005, when I bought my first place, you were getting like almost a 6% mortgage, because the interest rates at that time, or the bond yields, let's say, were at about 4%. Then obviously we saw a long downward trend. Real estate prices went up like crazy. People don't remember, let's zoom in a little bit here. People don't remember that bond yields actually did increase coming out of 2016. The real estate market was way overheated at that time too. We saw those going up. A little bit later on, we actually also saw, and I guess I can show you that too, the overnight rate at the same time also went up to try and slow down the economy at that point in time. And then, of course, COVID happened and we saw the massive increase in real estate prices because money was so cheap back at that time. But I'm going to zoom in here so you can understand why your fixed rate products are about to continue to drop, or at least have continued to drop over the last little bit. If you remember back to the spring of 2023, there was a banking crisis in the States. You had a couple of banks basically fold at that time. Everybody thought that was going to be the end of the financial world. And those 5-year fixed rate came down again. At this point in time, right around this 3%, when it was jumping up and down around 3%, you could easily here in Canada secure a 5-year fixed rate mortgage at 4.79. Well, if you fast forward to today, yeah, we went through a period at the end of 2023 in October when that rate jumped another 1.5 ahead of that, or a whole 1.5% above. So we were starting to see rates above 6%. 6.39 was not uncommon just about a year ago. But since then, we've had some ups and downs. And with the most recent cuts and the inflation data that's been coming out and the fear of the overall slowing in the economy, the banks and the markets and everybody else are predicting that interest rates over the next 5 years are going to be coming down. And now that we're right around that 3% mark again, it's not crazy to think that mortgages over the very short period of time on a 5-year fixed rate product could be around 4.5%. Now, reflecting back a little bit on the overnight rate, let's take a look here. So we had this superheated real estate market in 2015, 2016, because rates were extremely low. Then rates started to go back up at that time. If anybody remembers, if you were in the market in 2019, particularly here in my market of Surrey, prices were declining. And it's because interest rates went up. Then we had, of course, the pandemic. And after the pandemic, rapid inflation, interest rates shot up at an alarming pace. Of course, that means that real estate prices came off of their peak. And their peak was frothy, and they probably never should have been there in the first place, but they waited way too long to increase those rates. And now we're starting to see the backtrack on those rates down to 4.5%, and this will be 4.25% on September 4th. But let's talk about why we're going to be okay before I talk about why prices are going to continue to decline. Why we're going to be okay is you're starting to see products offered at 4.75% and even less. And that's a really important number. Now, in Canada, when you file for a mortgage, or when you apply, I guess, for a mortgage, you have to qualify for the rate you're getting or 5.25%, whichever is higher. Now, that number did change. It used to be 4.75%. So the people that were getting mortgages 5 years ago that were really strapped, they were all stress tested at 4.75%, meaning they could make those payments. So if those mortgage rates stayed at 6.5% for a long period of time, 5, 6, 7 years, you would have a lot of trouble in the market, and the market would likely come crashing down in all respects. I mean, a crash isn't really exactly what people think, but 20% is a heck of a crash in our marketplace. So you could possibly see that happen. But now all of the people, even that didn't do anything in COVID at all over the pandemic, they're all going to likely be just fine because the new rates are well within their stress tested levels. And on top of that, even the people that bought at the peak of the market, that crazy February 2022 marketplace, they were all stress tested at 5.25%. So in 2027, which is still some time from now, they do expect that rates will be, again, probably considerably less than this. You may be looking at 5-year fixed rates somewhere around the 4% level at that time, possibly even less. Variable rates could be as low as 3.5%, maybe 3%. Those people will all be just fine as long as they can hold on, and they didn't do what I consider to be an extremely foolish thing and hold on to these variable rate mortgages as they rose from like 1%, went all the way up to almost 7%. So long term, things are looking not bad. I think we're going to be okay. But why then, as rates are coming down now, will prices continue to fall. After all, rates coming down should mean more incentive and people jump back into the marketplace. Real estate goes up. It will, it absolutely will, but only eventually. Rates only come down because the economy is not doing well. We're going to start to see some layoffs. We've already started to see some layoffs. So as the economy gets bad, interest rates come down to help compensate for that economy, but the economy's already bad. You can't just change interest rates tonight and have the desired effect tomorrow. It's going to take some time for those rates to bake into the economy and provide some relief to businesses. And only when you get that relief to businesses and the overall economy does the real estate market start to pick up again. So it's important for everyone to understand as rates are dropping, the economy damage is already done and prices will continue to drop. But as rates stay down for a longer period of time, that will then again stimulate the economy and home prices will rise again. Now, the real question is, when will that happen? And the only way to answer that question for yourself is to subscribe to the channel for future videos like this one.